Welcome to the B.F. Anderson Technical Report for January the 13th. Every month, a trade group called the National Federation of Independent Business does a survey of small business owners and publishes the results as the Index of Small Business Optimism. The latest release of the index shows it jumping by 7.4 points to 105.8, which is the highest level since 2004. So it does appear that confidence is coming back to the economy. Now, a recent Gallup poll said that in 2007, 65% of Americans owned stocks. However, recently, that number is down to 52%. So if you realize there are 319 million Americans and that roughly 41.5 million of them have left the stock market. But as confidence builds, will they come back? So after two bear markets, which was the bear market of 2000 and the bear market of 08, and interest rates have dropped so dramatically. I mean, we are seeing a historic thing with interest rates. Now, what's interesting here, though, is since the beginning of the year, and really since October of last year, we're seeing a major breakout in the 10-year Treasury where it has broken this downtrend line. Now, we're seeing some pullback here, but the feeling is that interest rates are going higher as confidence builds. There's a reason the media is really negative on the market right now, and they're basically the main message is that the market is overvalued, and most valuation measures used by academics is the PE ratio. So let's kind of look at this PE ratio concept. In 2000, what I did is I took the top of the market in 2000, and I took each peak over a 3 to a 5 year period and found that the PE range for the market during the market top of 2000 was 27 times to 31 times. Then if you look at the same concept for 2008, the peak there, the PE ratio was 21 to 24. Again, if you take 2016, similar situation, the PE ratio has been 20 to 26. So common sense would say, gee, when you get over 20 times earnings, that's usually a market top. And this may not be true, because if you then take a look at market bottoms, now what I did was the same thing for the 2000-2001 low. The PE range was 20 to 38. If you took the low in 09, the PE range was 22 to 110. So William O'Neill, which is a great research firm out of California, they publish Investors Business Daily, they did an 80-year study, and they went back and looked at all the most successful investments you could have made over the last 80 years and determined that the most important factor was not the PE ratio, but was the growth in earnings. And in fact, the study goes on to say that if you insisted on a low PE ratio, or if you insisted on a dividend, you missed pretty much everything. You would have missed Walmart in the 70s. You would have missed Syntex in the 70s, which invented the birth control pill. You would have missed Microsoft in the 80s. You would have missed Dell Computer, Compaq Computer in the 80s. In the 90s, you would have missed Amazon. You would have missed Cisco Systems. The list goes on and on. So PE ratio can be a very, very deceptive tool, and I would be careful about using it. Now, what is more important? What is more important is the projected growth rate in earnings. Now, anybody who's been around Wall Street as long as I have knows that these projections, generally speaking, are not worth the paper they're written on. You just really have to study the company and see what their revenue growth looks like, and everything has to confirm. The revenue growth has to confirm, the cash flow growth has to confirm. So here's a little company called Shopify. This is a $5 billion company. Now what they do is they provide e-commerce solutions to merchants that desire to sell on the internet, like an Amazon. Now, in fact, Shopify recently signed a deal with Amazon, and that's what caused the stock to break out here. They're also working with Facebook. I'm hearing the big trend in retailing is towards social networking and Amazon. E-commerce is here to stay. The brick and mortar stores. Now look, here's some low PE ratio stocks that are large cap companies that are in brick and mortar retail. This is Kohl's. Look what has happened to this stock. It is totally collapsing. If you look at Macy's, same thing. You're seeing a major collapse here. So when you kind of think about it, you go, okay, would I rather speculate, because that's what we have to do, but I'd rather speculate on a company like Shopify that has a projected growth rate of 64.3% in earnings in 17. Even if you cut the number in half, you still got a remarkable growth rate. Or would you rather go with the old style stuff that clearly is not working? Now, another example would be Netflix. Netflix, again, they have a revolutionary new product. It's been around for a while. Started out with DVDs in the mail. Now they've gone to streaming, and it's just getting bigger and bigger. The projected growth rate on Netflix for next year, earnings are expected to be up 140%. Stock really broke out on the last earnings report, consolidated, pulled back, consolidated, now is breaking out again. Now, last but not least, I wanted to mention, and unfortunately my graph is not going to show the bottom of this stage, but this is Tesla. This is a company that is very controversial because they are manufacturing very high-end electric cars. Now, what happens here is you start out with something called a romantic stage. The stock goes up based on the dream of electric cars, and it's just a really romantic concept. Then you enter what we call the uncertainty stage. This is where the company has problems. They either have problems with the technology or they have problems with their financials. Y'all can all remember back here, this is when the cars were catching on fire, and they seem to have resolved this problem. Again, the stock took another big drop here when there was concern about their cash flow and whether they were running out of cash. So the real question now is Tesla now moving into what we call the reality stage? Well, all I can say is that they've launched the new battery plant called the Gigafactory, which will produce batteries for the use in stationary battery stations and also for the new Model 3 automobile. Now realize they've got 400,000 orders for this third generation car that they have. But the real story with Tesla, and I believe what will cause it to go into the reality stage and be successful, is the batteries. If they can get the cost of the batteries down where they become cost competitive, that's going to be the key. And the reports I'm reading is that the latest Gigafactory plant is going to produce batteries that have higher density, which means that they go longer, and they're bringing the cost down. I'm hearing that costs for these battery packs could drop to as much as $5,000, whereas back here in the romantic stage, the battery packs were costing $30,000. So big things possible there. So if you have any questions, give me a call. Thank you.